Aarati Krishnan and you're watching A to Z of stock market investing. Today let's look at Q for Qualified Institutions Placement or QIP. SEBI has such an elaborate set of rules for companies wishing to tap public investors that firms which are already listed often find it difficult to access the markets. Therefore, the company which is already listed and seeking more capital often shies away from the public markets and tries to raise funds through other routes. It is to avoid these companies shying away from public markets that SEBI has brought in a specialized set of rules for companies already listed to raise fresh money. This is the Qualified Institutions Placement route or the QIP route. A QIP is a fundraising effort in which a listed company which wants to raise fresh money for expansion actually taps large institutional investors for these funds. It does not go or reach out to the retail investors or to the public. Usually, listed firms seeking to raise fresh money can do one of three things. They can go for a rights offer to the existing shareholders, or they can do a follow-on public offer in which what they do is they try to rope in new investors apart from the shareholders who are already there in the company. Thirdly, they can make a preferential allotment to the promoters based on certain rules set by SEBI. But what if a company wants to do none of this and wants to actually shorten the process substantially? Then it uses the QIP route. The QIP route allows a company to tap only a few large shareholders for the money that it needs for expansion. Only qualified institutional bidders or QIBs can participate in a qualified institutions placement. So who are these QIBs who are eligible? It could be public financial institutions, that is these large institutions who lend for big projects. It could be banks, it could be mutual funds, insurance companies, pension funds, multilateral development agencies and such large institutional investors. Only these are eligible to actually apply for and buy shares or bonds in a QIP. Well, SEBI reckons that institutional investors who participate in a QIP do not require the same degree of protection as retail investors in IPOs. Therefore, it has substantially shortened the process through which companies can raise funds through this route. Firstly, a company can launch a QIP simply by obtaining the prior approval of its shareholders. Secondly, it need not file a detailed RHP or red herring prospectus with SEBI ahead of the offer. Instead, it needs to upload its placement document on its own website and also provide it to both the stock exchanges so that prospective investors can check on the company's details. Thirdly, at least 10% of the shares on offer in a QIP have to be placed with a mutual fund. This is designed to ensure that there is some mutual fund participation in QIPs and that they can ensure some minimum degree of governance with respect to the listed company. Fourthly, QIPs are also required to have a minimum number of investors. So QIPs of less than 250 crore size can have 2 investors as the minimum. QIPs with more than 250 crores in collection should have at least 5 investors at the minimum. Apart from this, QIPs are also required to file a placement document with SEBI once the entire offer is concluded. So, a issuer of a QIP hires an investment banker to handle the whole process. The whole advantage of the QIP process is that it helps companies to raise money in double quick time. Well, a cash-strapped company or a company with high leverage may have a debt repayment coming up and it may want to raise equity money in order to pay down debt. In that case, it cannot afford to wait for the long period it takes to file a RHP with SEBI, get approvals, advertise its offer and so on. Secondly, an IPO or an FPO, follow-on public offer, can also be an expensive affair because to raise money from public investors throughout India, a company may have to advertise its IPO quite heavily and spend on promoting its corporate image, logo, plans, and so on. We know that many IPOs in India do not actually make money for their investors. In fact, there are a large number of loss-making IPOs. Given that QIPs are only subscribed to by the smart guys and the big guys, the institutional investors, do they always prove to be profitable? Not really. If you see today, a lot of QIPs that were placed in 2013 and 14 are currently trading below the offer price at which the institutional investors bought shares.